Hi everybody, I'm Steve McDonald. I'm one of the editors at IDE. In focus today, a 6% savings rate in the U.S. Unbelievable. Investors are doing the 180 degrees out dance again. Pakistan is a buy. And the Rio Tinto China bid for potash. And of course, the slap in the face award. Well, the savings rate for the U.S. is now at an astounding 6%. Astounding. Why? Because a few years ago, it was around 1%. So what happened? Fear happened. When we had the foundation of our belief in this system yanked out from under us by a handful of Wall Street thieves, people took a step back, looked at their lives, and realized we had been living like a bunch of drunken sailors. The savings rate is now being portrayed as a negative since it eats into this consuming that this economy has come to rely on. But it is really a big positive for the future. A high savings rate can only benefit this country going forward. It will be the basis for future growth and investment. It may not be the answer to a quick fix for the economy or retail sales, but haven't we had enough quick fixes for one lifetime? Next up, the 180-degree dance. I know this is cruel to say, but the biggest joke in the retail brokerage business, that's where the average investor used to buy stock, is the investment behavior of the average investor. When the average investor is ready to buy, it's time to sell. So what does that say about the trillions of dollars that are leaving the stock market that is priced, by the way, at 1970 inflation-adjusted levels? These trillions of dollars are going into long-term bond funds at all-time low payouts. That's the amazing part. Nothing ever really changes. That's what it says. Once again, the little guy is letting fear drive his decision-making, and the outcome will be identical: huge losses. Some analysts are predicting the losses in the bond mutual fund bubble that's forming could be on the same level as the 2008 and early 2009 losses in the stock market. Most investors are buying into these bond funds thinking they're safe from the type of losses they have just run from in the stock market, and they couldn't be more wrong. It isn't where you invest, it's how and when, and most investors are 180 degrees out of sync with this idea. For many years, I have believed a person should be required to demonstrate minimum competency about investing before they be allowed to, by themselves or with a broker, it doesn't matter. The losses incurred by the average guy are so monstrous, we can't even begin to total them. Most of it isn't because Wall Street is crooked or because the government is run by a bunch of boobs. It is. But the reason that we're having a problem is most of these losses are the result of a complete lack of understanding about how the markets work and how to play them. It is truly a national disgrace. Next up, Pakistan. The horrible flooding in Pakistan has caused a big drop in the valuation of the stocks in that country. And Mark Mobius, you might remember him from his fame in China in the 80s and 90s, is stepping up and buying on the bad news there. Mobius said in an interview last week, the bottom line is that Pakistan is not going away. We want to buy stocks that look cheap as prices come down as a result of the flood. And he's a pro. Why can't everyone else see that about the U.S. market right now? Because it's exactly what's happening here. Anyway, Mobius oversees about $34 billion in developing nations' assets as executive chairman of Templeton's Emerging Markets Group, said the investment companies that he favors are banks and energy companies in Pakistan. Potash Corporation. Well, everything is abuzz about the BHP buyout of Potat, and it's been ratcheted up a notch by the possibility of another buyout offer from Rio Tinto and a Chinese fertilizer group. Or has it? In an article this week in the Journal about the existence of a competing bid from another company, it's being questioned. It seems no one at Rio Tinto knows anything about a bid from potash or for potash. Either the potash board is just trying to drive up the offer from BHP, which I think is very possible, or Rio Tinto is being very secretive about their possible impending offer. Either way, the prudent thing is to use a trailing stop here to protect any profits you may have. The price may go up to 160 or go down just as quickly to 130. No one on either side really knows yet. Be safe. Don't bet on either side. Use the trailing stop. And now the slap in the face award this week. It's going out to the Federal Reserve, Mr. Bernanke and company. It seems the decision to be even more accommodative and in essence add more money to the system in their recent decision was one that had a lot of resistance from many of the Fed governors. The thinking by the opposition was that it could be seen as a negative by the markets or an indication from the big boys that things are in fact getting worse and it would backfire on them. Well, guess what? It did backfire. The markets viewed this move as a sign that the recovery is in fact weakening even further, evidenced by the fact that the Fed had to act again to rescue it. Way to go, guys. We don't have enough uncertainty out there. We needed the Fed to add in another dose. Now, do you think the fact that the administration has been unable to do anything about unemployment rate 3 months before the midterm election had anything to do with this decision? You think? I don't know. Anyway, for everybody here at IDE, I'm Steve McDonald. Thanks for being a part of this, and I'll see you Friday in the Weekend Wrap-Up.